to take this series again. We are having with us today the faculty of session C. Sanat Chitale and the coordinator C. Yogita Bharti. I request Mishaji, the staff of WRC, to start with ICM module.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Good evening, everyone. Let's back to our initiative to create awareness on auditing and Ind AS standards. Today we are having one of the very important topic, expected credit loss model. Everybody talks about financial instruments, and when you just talk about implications, the implication of financial instrument for non-financial companies comes down to one adjustment which is there for every company, which is ECL. However, there are a lot of issues about practical applications of ECL, and whether we have to revisit ECL provisioning, how to revisit, what kind of document is required as an auditor, how can we ensure that it is correct, can I make comparable with my peer company, or it has to be a company specific, what kind of documentation I should keep. So there are a lot of things are there, and today we are having a very eminent faculty who has been dealing in this particular area, say Sanat Chitale. Welcome, faculty. I'm sure that with your experience of dealing with ECL for various companies, the participants will be immensely benefited. I request the coordinator, C. Yogita, to warmly welcome with a brief profile of the faculty.
Thank you so much, Chandan sir. Yeah, so hi everyone. Good evening all. We have today Sanat Chitale sir. He is a partner of MP Chitale and Company, and he's partner since 2014 of the MP Chitale and Company firm. So it's been 10 years. He is being the partner of the firm. To give a brief background about Sanat sir to for everyone, for the benefit of everyone. So he is based out of Pune and heads the Pune branch of MP Chitale and Company. He specializes in statutory audits of banks and NBFCs. He's also qualified member of the Institute of Chartered Accountants in England and Wales. He's a special invitee to take the session on Ind AS supervisory assessments of non-bank financial companies, NBFCs for SSMS and College of Supervisors, Reserve Bank of India. Followed by that, he is one of the signing partners of the firm for the BFSI sector. He is also taken special interest in social initiatives and is an active member and director of Chitale Foundation Charitable Institution as well. He is also a treasurer of the British Business Group, Pune chapter BBG. Additionally, he has been a part of many working groups of the institute. To mention few, he is being a member of the ICA Expert Advisory Committee for the financial year 2021 and 2022, and also for financial year 2014 and 2015. He was also empaneled as a technical reviewer with the Financial Reporting Review Board of ICI. Additionally, he was a member of the ICI study group to prepare the guidance note on audit of banks for the years 2017, 2018, and 2019 editions. He was also a special invite of the Center for Audit Quality Directorate for the financial year 2014. That's the very recent one. And additionally, he was a member of the Banking, Financial Services and Insurance Committee of the WIRC branch for the financial year 2017 and 18. That's a very brief background about Sanat sir. Uh, Giving back to Sanat sir to give us an entire overview about the session. Thank you so much, everyone.
So, good evening, everyone. First of all, I would like to thank the management committee of WRC of ICA, also specifically Chintanji, who has invited me to express my views on ECL, which is a humongous chapter to honestly explain in a couple of hours' time. Last but not the least, Chandan Lahoti as well, who has actually reached out to me and to see if I can actually come over here and express my views. So, I thank everyone who has taken efforts to have this session organized. And hopefully, you will have a very good insights or learning in this session. So, by the permission of the chair, if I can just share my screen and start our session.
Please.
Yeah, thanks. So, do let me know if my
It's
screen
visible.
is visible.
Yeah,
It is
visible.
visible. Great. Yeah. So this is a huge chapter, and what I've tried to do is that bring in practical aspects of implementing the ECL and also how it is carried through these stages. So it can be a very nascent company or a bank or an NBFC. It can be a company who has reached at a matured level and a growing company as well. So I've tried to tick all the boxes over here. First and foremost, I would also like to state over here is that I have tried to compress all the examples in my presentation, and also I have tried to compile an Excel sheet for benefit of everyone, wherein I will share as to how the ECL computation is done. So let us start with a very good evening to everyone as well. First and foremost, I think this is the one of the most important slides for me, that these are my personal views and not to be construed to be views of ICI, regional councils, or my firm. These views should not be considered as a professional advice, and whatever images, logos, screenshots are presented, if any, they are part of the respective software developer and trademark owners. So now, before we begin, what I'll suggest is that just for clarification, sake of clarity, the thing is that Ind AS ECL is only applicable in NBFCs and for companies whose net worth is above 250 CR in the previous year. Further, in case of banks, RBI has come up with a working paper, or they have elicited interest and responses from firms and banks who are actually privy to working in this environment. So it is still not applicable for banks in India. Only a working paper has been circulated. However, whatever experience I have while working with banks, as they are also started working in the ECL, even though it has not been implemented mandatorily by the regulator. So first of all, we start with the financial instrument. What are the nature of financial instruments? What is the business model? Which then obviously decides the end days classification. So, and then the ECL part of it. So first is loan portfolio. In this case, the business model happens to be to retain till maturity or sale of portfolio after origination. Now, typically in case of medium-sized NBFCs, to raise capital, they have found a method of actually raising a portfolio by giving loans to borrowers, and then they sell that portfolio to banks because the banks get the priority sector lending criteria fulfilled from such assignments from the NBFC. So in this case, what happens is that if the cash flow is specifically related to sole payment of principal and interest, it is catered to as to retain till maturity, and if it is otherwise, it is classified as FVOCI. So there are two classifications possible for a loan portfolio: amortized cost and FVOCI. In case of trade receivables, obviously most of the entities retain till maturity, so it is at amortized cost. In case of investment in MF, surplus funds invested for short term, and it is FVTPL. For other approved securities, debenture, bonds, it is retained till maturity unless selling results into higher profit. So opportunistic sellers also get clubbed into FVOCI. Fixed deposits with bank, amortized cost. Security deposits, almost the same nature, so the same treatment. Subsidiary joint ventures is cost or FVOCI. Now, what is the scope of ECL? So before we start, we need to have a macro level view as to what is the scope of ECL. So in case of financial instruments, instruments which are classified under FVTPL and equity investments at FVTOCI, ECL will not apply because in case of FVTPL, directly each quarter or at each reporting period, the entity recognizes loss or gain directly in the P&L. In case of equity investments of FVTOCI, election is made at the time of recognition. Now, the largest chunk of financial instruments which are for which ECL applies is debt instruments at amortized cost and FVOCI. So, debt instrument typically includes bonds, loans, and advances and trade receivables. Then, a peculiar thing is regarding loan commitments and financial guarantees, which we'll definitely see in our further slides, because typically in our earlier avatar of the accounting standards, loan commitments and financial guarantees were not subject to a provision because they were off balance sheet items. So loan and commitments and financial guarantees would include LC/BG, that is a letter of credit and bank guarantee, or any other loan commitment given to the borrower. Now, let's get started with understanding the ECL. So, first of all, we just try to understand what is an ECL. Expected credit loss is an estimate of loss that an entity expects from a result of occurring of a credit event. So, for example, a payment default. Now, over here, I think there are two concepts that we need to understand. First and foremost is the concept of a default and the concept of a loss. So when we say default, we would like to first understand the concept of default. So say for example, I Sanat Chitale have taken a loan, and the it is into the payment is dependent on EMI, that is equated monthly installment. So my loan becomes due on 1st of August 2024. Now, if I don't pay on 1st of August 2024, you can say that I have defaulted on my loan and I am into the bracket of 0 to 30 days. Now, what happens is that if I still don't pay, then I would go further in the bucket and I'll fall between 30 to 60 days. And still, if I don't pay, I'll go into the 90 and above bucket. So now I have defaulted on my loan and I've started migration from 0 to 30 days to 90 days and above. And if I still don't pay the loan over a period of 1 year, what will happen is that the bank will chase me and consider it as a housing loan. They will take the possession of my house from me and they will sell it into the market. So, say for example, I had taken a loan of 50 lakh rupees, and out of that, 25 lakh rupees is only what they were able to salvage based on the amount which they could get from the new buyer. And I had paid a loan of around 15 lakh rupees. So 50 lakh is the loan amount, 25 lakh is the salvage, and 15 is what I have repaid the bank. So if you take the addition of it, it comes to 40 lakh rupees. Now, what has the bank lost is 10 lakh rupees. So that is a loss. And what I have defaulted on is the amount which I was supposed to pay in on 1st of August. So you need to take into account the main difference between default and loss. Second is that it is an unbiased probability weighted amount based out of possible outcomes, based on considering a host of factors like risk and geographical factors and what is the probability assigned to that asset. So when we say ECL is a forward-looking expected credit loss is forward-looking model, obviously there is a probability that a credit event, unfavorable credit event will occur or it will not occur. So obviously there is always a 50% probability. Hence, when you work out an ECL model, probability needs to be assigned to each of the probable factors and whatever practical way it is possible. In the further slides, I have tried to address this issue as to how probability can be given. Third is that it can also be defined as a difference between expected cash flows from the contracted amount vis-a-vis cash flows which the entity expects to receive based on historical data and also after adding qualitative factors to project whether there can be any future losses. Then it is considered as a superior method to the concept of incurred loss model, which is still followed by banks. So typically, in case of banks, what happens is that RBI has come out with the IRACP, IRAC provisioning norm circular, wherein it says that after 90 days, you have to take certain amounts of provision on the loans which are defaulted after 90 days. However, in case of ECL, what it tries to do is that it tries to anticipate or preempt any future losses that might happen to the asset at day one itself after recognition of the loan. So that is the difference between rule-based or incurred loss model and ECL, wherein it tries to predict the future based on historical data and other qualitative factors. Whereas in case of incurred loss model, the provision only hits the books of account once it has incurred. Third is, as we discussed, concept of forward-looking estimate and considering a broader range of information than incurred loss model. Last but not the least, when we say ECL, it requires host lot of information, probabilities, models, a lot of prior period data, a lot of assumptions as to what can happen or not happen in future, and hence a significant amount of estimation is required. And typically, the ball starts rolling from the management side when they start making the ECL, and then the auditors vet that model. So a significant amount of estimate is required in making the ECL model work. Now, what are the approaches that might be that are required for the ECL computation? So in case of an ECL model, there are three approaches which are there as per Ind AS 109. One is the simplified approach, or as we call it, a provision matrix. So in case of provision matrix, what happens is that it is only applicable to trade receivables or contract assets or lease receivables that do not contain a significant financing element in it. So typically, when we say significant financing element, we say that the shelf life of the receivable should get over within 1 year from the reporting date. That is a general meaning when we say that financing element or component will not be included. That is only when we can use the simplified approach or a provision matrix. And as a practical usage, simplified approach makes a lot of sense for typical trade data in manufacturing industry or other industries wherein receivable is expected to be recorded within a period of 1 year. Second is the general approach. At each reporting date, an impairment loss allowance either using 12-month ECL or lifetime ECL is used. And second point over here to note is that ECL also depends on whether there has been a significant increase in credit risk or SICR, and what are the key factors or key pointers from which we need to anticipate that there has been a significant credit risk which has increased since inception or initial recognition. And third is a very honestly a rare thing, that purchased or originated credit impaired assets. In this scenario, what happens is that at inception or at a recognition, the asset is totally impaired. So what can come to my mind is that if a bank takes over another NBFC or an NBFC takes over another NBFC, whatever assets the other NBFC has might be originated credit impaired. So might be that they cannot be recovered at all. So these are certain circumstances where a purchased or originated credit impaired asset may come into existence. Now over here, the treatment or accounting is a bit different. In case of such assets, impairment is determined based on full lifetime ECL. However, lifetime ECL is estimated at the inception or initial recognition, and cash flows are to be computed and accounted for using the credit impaired EIR. So we assume that what is the probable cash flows that are to be received from this asset. So say for example, if my normal EIR would be 15%, for a credit impaired EIR can be around 5% or 4%, depending on what is the characteristic and nature of the asset. Now, while following simplified approach, I think we need to also take into account the very nature of the trade receivable. Now, as I mentioned earlier or iterated, that it shouldn't have a significant financing component. Now, what does this mean? So, a basic benchmark over here or a thing to follow is that it should get recorded within 12 months. Now, take an example of a contractor whose receivables are honestly honored within 6 months of him completing the work, or a contract period may be less than 12 months. However, what happens to the retention money which is left with the customer? Now, in that case, there are two views possible. ICAI has also come up with an expert opinion on that, that is given by the EAC, that if the company feels that there is a significant financing component involved, because the retention money typically gets paid over 3 to 4 years, then ECL obviously would be applicable. If it is not, then ECL would not be applicable. So it is a subjective thing, and a lot of subjectivity obviously is involved in deciding such factors. This is just an example, kind of an eye opener as to how things can change based on different clients or customers. Now, let us first understand what is the simplified approach or provision matrix. Now, in case of simplified approach, what we do is that first is we need to define what is the appropriate time period which needs to be taken to analyze the proportion of lease or other trade receivables, and which are written off or as bad dates for T period. So T period, you can take it as the earlier financial year from when T+1 period happens. So in T period, what has been the behavior of the trade receivables? Any trend can be honestly derived from that data, and then it is applied to the forward-looking data or the trade receivable which are there as on the period of reporting date. Now we'll just see how it is computed. So this period ideally should be adequate to provide you useful information and should enable you in taking a decision. Too short a period might result into information that may not be meaningful or useful for implementation of this simplified approach, or too many long periods may also render changes in underlying market conditions which are redundant. So typically, we will start with a period of a year, which is deemed appropriate in most of the cases, except for something like retention money. So first is we start with an example like total receivables are 10 lakh rupees. Bad dates written off are 30,000. So we can call it bad dates written off or loss assets. So nothing which cannot be recovered is called as bad dates written off or loss assets. And time period of data is 12 months or a financial year. Now, step two, what we do is that we actually have uh, a table wherein total receivable timeline is plotted, and these timelines should be linked to your agreement. So, say for example, if you are a manufacturer of goods, and typically the credit period is over there would be 60 days, 30 days, 90 days. So typically it should be mapped to your agreement for a better result or an accurate result. So what I've done over here is that in this example, we are taking 10 lakh as the total receivables. What is the recovery that is happening in each of these periods? What is the cumulative recovery, and what is the remainder amount of receivables? So first is 0 to 30 days. In case of 0 to 30 days, we have 2 lakh rupees of recovery. So cumulative recovery obviously is 2 lakh because nothing has come before that. So the remainder amount is 8 lakh rupees. Now, in 30 to 60 days, we have a recovery of 3 lakh 50,000. Cumulative recovery is obviously 2 lakh plus 3 lakh 50,000. So cumulative is 5 lakh 50, and a remainder amount is 10 lakh minus 5 lakh 50. It gives me an amount of 4 lakh 50,000. 60 to 90 days, I have a recovery of 3 lakh. Cumulative is 8 lakh 50,000, and remainder amount is 1 lakh 50,000. And after 90 days, recovery is 1 lakh 20,000, cumulative is 970, and hence we get a loss figure of 30,000. Now, when we say this is the loss figure, the company has, or the rather the entity has arrived at a conclusion that this amount cannot be recovered from the debtor. So that is why we have called it a loss amount. Second thing, why we have taken 0 to 30 and 90 in all of the future examples as well, is because of the rebuttable presumption which the standard has in days 109. It has a rebuttable presumption that beyond 30 days, SICR has happened, significant increase in credit risk. And beyond 90 days, it is a presumption that the company, or rather the customer, will default. So these are the two presumptions on which all our examples would be based, because it is the basis of computation of ECL. And if you have to actually rebut the presumption that even though it is more than 30 days, it is not SICR, or there is no significant increase in risk, then you have to show it via data points or documentation wherein you say that it is possible that even after 30 days, SICR has not happened. We will also come to a few examples later when it is actually practically possible, which I have also seen it. Now, coming to step 3. In step 3, you need to now compute the historical default rate. So when we say historical default rate, it is the percentage based on time period vis-a-vis the aging of the receivables of rupees 10 lakh. So here we need to derive what is the default rate. So again, a table represents the same. So here receivables at each time period, total loss and default rate is derived. So here total receivables are 10 lakh, receivables greater than 30 days is what we saw in the earlier slide. I'll just have it over here. So it is 8 lakh over here. 4 lakh 50,000 receivables after 60 days. It is 4 lakh 50,000. 60 to 90 is 150. So it is 150. Now what we do is that, sorry. So what we do over here is that we plot the total loss across the buckets. Because as we know, we have arrived at a total loss of 30,000, which is shown in our data. So over here, what we have done is that we have pasted this 30,000 loss across all the buckets. The meaning of it is that it is not possible, obviously, to identify which of these time period buckets are responsible for this 30,000 loss. So the assumption is that each of the bucket has contributed to this loss. So when we align this 30,000 or rather plot this loss against each of the bucket, we get a default rate. So over here, 30,000 divided by 10 lakh rupees is 3%. 30,000 divided by 8 lakh is 3.75%. 30,000 divided by 4 lakh 50,000 is 6.67%. And 30,000 divided by 1 lakh 50,000 is 20%. Now, if you see, as the periodicity or as the aging increases, obviously the underlying default rate increases. That it is evident from this as well. Then, fourth thing is that what we have done till now is that we have only tried to derive what is my failure rate or what is my default rate and what is my loss rate over the entire period of 1 year. So my default rate for all these periods is as presented in this table. Now what we do is that here comes the ECL part, because till this slide or till step 3, we are still in the loss incurred model. So we have only tried to plot the losses that they have, which have actually incurred in the receivable. So till now we are at the loss incurred model. Now, when we say forward looking, so what we do is that in this 30,000, we try and make sense of changes in economic, regulatory, technological, environmental factors, industry outlook, GDP, political stability. Now, it may seem theoretical factors, but obviously it all depends on the clients and what is their data or customer, in which category does it fit. So say for example, in case of demonetization, in case of GST implementation, wherever SMEs were involved and wherever it was a tier 1 a vendor and the customers were SMEs, a lot of stress was seen in the SME sector, in banks as well as MSME, in banks as well as NBFC. So at that point of time, what we did is that obviously the cognizance of these changes, GST implementation, demonetization, which are applicable to such sectors has to be taken. And obviously there is a model around which you can tinker and then say that if my ECL is around 30,000 rupees, I can add say 30% of it, which can be only devoted to factors such as GST implementation, MSME stress, or COVID. In case of COVID, it was a completely a different animal. So in those cases, what stand the companies have taken is that they have coined the concept of management overlay. So honestly, something which is beyond you or beyond perception as to how to compute it, a 20%, 25% management overlay was taken over and above the ECL rates. In certain cases, obviously, it is admissible by RBI and it is a accepted practice now. However, in certain companies, they computed that and they tried to subsume it in their ECL model itself rather than having two stages of ECL. First is normal ECL and then adding up a management overlay layer over it. So other external market indicators are rise in repo rates, rise in commodity prices, upward wage revisions in sector, forex movements, etc. So in certain sectors which are very price sensitive or very sensitive to rise in repo rates, example, classic example can be developers, because their customers are rate sensitive in the sense that in a rising interest rate environment, obviously, sale of houses gets impacted and vice versa. So if you have data, a company may also suggest that 100 basis points increase in interest rate or repo rates will result in 5% increase in risk. Now, whether that 5% is within your tolerable error or not depends on the data. So this is how you actually subsume this information in your ECL model and then refine it further. Others include internal rating downgrades, which is fairly available data at the matured NBFCs and banks. Funding issues at customer is customer centric, and current client base analysis. So now in current client base analysis, what typically happens is that if your client again belongs to a category which are now impacted by rising commodity prices. So for example, if he deals in copper, his raw material is copper, and rising copper prices are impacting his gross margin, and he's not able to pass the rise in cost to the end consumer. Such clients can be identified. So it is a very subjective thing as to how do you apply it, but I've just tried to give you points as to how then you can join the dot and find as to how best the ECL model can be implemented. Now, based on the above mentioned forward-looking factors which we discussed and I iterated just now, if the management of the entity decides to adjust the incurred loss additionally by rupees 10,000, the provision matrix will be adjusted as follows. So now we have added rupees 10,000 to the earlier loss of 30,000, which was over here. So this is the 30,000 loss based on our analysis of forward-looking factors such as which is mentioned over here, rise in repo rates, commodity prices. In this example, we assume that we say that there is a 33% chance of default, and hence I have taken that 33% of 30,000 and it comes to 10,000 rupees. Now, what we will do is that we will again plot the same figures over here, and over here we will replace 30,000 with 40,000 rupees. So now this is the ECL derived total loss. Now my default rate reads as 40,000 divided by 10 lakh, which is 4%, 40,000 divided by 8 lakh, which is 5%, 40,000 divided by 4 lakh 50,000, which is around 9%, and 40,000 divided by 1 lakh 50,000, which is 27%. So this is what we get based on our adjusted risk profiling of our customers. Now, the final step is computation of final ECL. Now, computation of final ECL by application of default rates as derived from step 4 and by applying it to the total receivables. Now, over here, I have kept the total receivables as same as it would be. Now we are in T+1 period. Whatever data crunching was done for T period. Now we are into T+1 period, and we will be applying the assumptions and the data which has been derived in T period over here. So what we get over here is 4% default rate, which we have derived, 5% default rate, 8.89, and 27%, and it has been derived over here. Just for your reference, I am just going to our previous slide wherein we have derived all these rates. And what we do is that we actually apply them to over here. So current receivables are 3,50,000. It is 4%. In 30 days bracket, it is 3 lakh. In 60 days, it is 1 lakh 50, and in 90 days, it is 2 lakh. So these are random figures. It will not match to your earlier figures because it is T+1 data. So now what we get is that 2 lakh into 27% is 54,000 ECL. 1,50,000 into 9% around is 13,335. 3 lakh into 5% is 15,000 rupees. 3,50,000 into 4% is 14,000 rupees. And 10 lakh into so obviously this will not apply. This 10 lakhs would be an addition of all the earlier ECL percentages and application of it. So your total ECL would be addition of 54, 13, 15, and 14. So on a 10 lakh receivable, the entity will recognize rupees 96,335 as your ECL in the simplified approach. Now we go ahead and we explore some of the other historical loss rate models. Would just like to stop over here and ask if there are any questions related to simplified approach, because the other approach is a bit different from this one. Great. So not able to see any question. So now we go to the next slide. Now, these are all historical loss rate models. Now, the RBI, before implementation of NBFC, before implementation of ECL in banks and NBFC, had constituted working groups for submitting their views on implementation of ECL. Now, as we stand, still it is not implemented in banks. At that point of time in 2015 onwards to 2017, a lot of consultation happened. But at the end of the period, the RBI suggested that time was not ripe for implementation in the banks because of high NPAs at that point of time. So it is now only applicable to NBFC. However, for a uniform application, yes, somebody has asked me one question that so by the example, effectively the default rate is 10%. Yeah, that is correct. Effectively, it is 10%. So now, coming back to our topic of RBI working group report, the thing is that it submitted a report in February 2017 and it has suggested a couple of methods uh, for historical loss rate model approach. So first is the roll rate model. So it typically is used widely in retail portfolios. Just one moment. I have another question from Swanan that what if there is specific provision for doubtful dates made by management for specific debtors? Still, one should calculate ECL on that particular receivable. So, Swanan, honestly, whatever rate the management has used needs to be backtested to say that whether this rate is correct or not. And then, based on the factors which we just discussed, you need to see whether that rate is justifiable and should sustain. You can also then group the customers based on their geographical reach, their product mix, and what risk does that customer carry. So based on that, you can actually come to a conclusion. Is from Trupti, we have another question. Is there any ECL matrix format that is to be followed in practical life? So honestly, whatever I have showed you, you can follow that in practical life as well, because this is one of the practical examples which I've tried to subsume in this PPT in the format of a table. So this is a practical example. Right. For trade receivable with SICR and credit impaired, 100% to be no, I think I have explained it in the other slide. So SICR concept is not applicable in case of that simplified approach. SICR comes into picture in the general approach, which we'll be taking in other slides. Then on current land base analysis, like commodity prices for outstanding receivables, forward-looking factors won't apply. No, they would definitely apply. They would definitely apply. And the ECL rate is a combination of all such factors. In certain cases, these factors would not be, honestly, you might not be hands-on with such factors, but based on any external factors, internal credit rating, you can take a call. Right. I think we'll just move on. So in case of roll rate model, it is widely used in retail portfolios for loss forecasting and involves division of portfolio into different buckets. based on risk or delinquency status, measures the percentage of exposures that will migrate to a more or severe risk rating, which is defined as the roll rate between these two buckets. So, say for example, we have three buckets: 0 to 30, 30 to 60, and 60 to 90. Now, in this case, how do you compute a roll rate? So, when we say roll rate, it is actually a migration from 0 to 30 to 30 to 60. So, whether my risk increases, we call it roll forward, or risk reduces, roll backward. Now, I'll just explain it via an example. Now, amount of loans delinquent at 60 days divided by amount of loans delinquent at 30 days. So, if I have to have a roll rate at 60 days, what do I do? If I have 10 lakh rupees worth of loans delinquent at 30 days, so they are in my first stage one, that is 0 to 30 days, and only 60,000 of them are in delinquent in 30 to 60 days. What I do is that I divide 60,000 by 10 lakh rupees, so I get a 6% rate, meaning that out of 10 lakh loans, I expect 6% to move forward. So my credit risk has increased in those bucket. And if I have to take it for 60 to 90 bucket, if the entity has one, then what happens is that, say for example, 30,000 has moved to 60 to 90 bucket. We divide 30,000 by 60,000, the previous bucket, and then we arrive at a roll rate of 50%. So in total, what we say is that out of 10 lakhs, 6% will move to 30 to 60, and out of 6%, 50% will move to 60 to 90. So that is 30,000 rupees. So that is how a roll rate is calculated. Typically, where do we use this method is where there is no longer period horizon data available. Now, typically what happens is that in case of entities which have just have been incorporated, see for example in 1617, they do not have that much of data till 2024 to have other ECL models implemented over there. So only option available is this roll rate model, which in case actually we can see what is the susceptibility of borrower to move from one bucket to another bucket. Also, this is a very common method used in banks, even though banks are not into the ECL model. But internally, as they are moving into ECL model, they use this for credit card portfolio, because typically credit card portfolio has many buckets. First is 0 to 30 when the account becomes due. Then 60 to 90, 90 to 120, and 120 to 150. Now, I think I'll just try to draw your attention that how a specific product can actually alter your other ECL model. Now, in case of credit cards, typically what happens is that in your initial period of 40 days, you have a credit period which you can use from the bank of 40 days. So obviously no interest penalty is payable for first 40 days. After that 10 days, once that 40-day period is over, after 10 days, you have an option to pay a minimum amount or gross amount. If you default on that, say for example, SI is not present in your, that is standing instruction is not present in your account, then what happens is that it falls into the other bucket and then you are into default. However, practically what I have seen is that I don't want to use the word encourage, but banks obviously want the person to default so that they can then charge a rate of 3% per month or 36% per annum. And it goes on till 120 days. And after 120 days, the bank starts chasing that person, after which he pays that amount. And if you see, I have been privy to some of the bank's data. So if you see that there is a trend available over there wherein the person actually pays the entire amount after 120 days. Now, we have learned about that rebuttable presumption. Now, over here, if your data can show that even though after 90 days my client is paying, 95% of my clients are paying, then you can definitely use this model only for your credit card portfolio. And for the other portfolios, obviously the ECL model, which has been implemented at the entity level, will work. So this is how you have to role play between different products, because the credit card model is completely different from the other products. And obviously, people who use credit cards are mindful of their credit history. So very seldomly people default on their credit cards. And it is unsecured. So the provisioning would be extremely high as it is unsecured rather to a portfolio which is secured or has a collateral to it. So just wanted to bring in that credit card example so that you are well aware of the fact that each product may also warrant a different ECL model. Now, this is a model which is honestly used at most of the NBFC. This is called the vintage loss model. So, as the name suggests, when you say vintage, it needs to have a greater time period at your disposal. So, we'll just see how it works. This approach involves segmentation of portfolios by vintage and additional criteria. So, first thing is segmentation. It starts with segregation of loan origination for a loan pool into different vintages. And for each vintage, management must determine when any of the loan losses occurred, assign them the appropriate vintage loss period. Then the next step is that for each vintage, so each time period is called a vintage over here. For each vintage, management must determine when any loan losses occurred and assign them the appropriate vintage loss period. So over here, when we say vintage, what typically happens in case of housing loan? Now, these are loans which span over 20 or 30 years as well. So highest maybe around say 30 years for sake of our discussion. So how do you compute a probability of default or a loss over a period of 30 years? So for that, what we do is that we first start to gather data which can give us an insight as to what is the current credit profile of the HFC or housing finance company. So over here, we have again taken 10 lakh as the amount. And over here, we are considering a consumer loan of 2 years so that it is easy for me to portray. And I'll just try to juxtapose it to a housing loan of 30 years. This is for our conceptual understanding. That is why I have taken an example over here of 2-year consumer loan. So a 10 lakh worth of 2-year consumer loan originates in April 2022. The company has identified all the loan losses for this vintage and calculated a vintage loss rate. So the amount has been disbursed in April 2022, and this is the result. So this is not a single loan. It is cumulative loan amount is 10 lakh rupees, and out of that, these are the following quarters in which actual losses have happened. And this is the loss rate. Now, I again circle back to my first slide wherein I told you that there is a difference between default and loss rate. So I just take another example over here. So there is a consumer loan of 1 lakh rupees. And out of that 1 lakh rupees, if the, 1 lakh would be a high amount for a consumer loan. Say, for example, 50,000 rupees is a consumer loan. And out of that, the client has paid 30,000 rupees of it, and the company has been able to salvage additional 10,000. So again, we are up to 40,000 rupees. 10,000 is the loss amount over here. So when we say actual loss, it is this 10,000 rupees which is over here, and that translates to the loss percentage. So it is not the default amount, it is the loss amount. Vintage is not very clear. Could you please explain again? Yeah, sure. So when we say vintage means time period. So this model is applicable to institutions or entities which have a large history of their existence. So say for example, we have Axis Bank into existence for last 30 years now. So we have a lot more data to play with vis-a-vis, for example, an NBFC which has just been incorporated 5 years back. So we have the liberty or the comfort of the data of last 30 years behavior of a portfolio. And that is why we call it as vintage loss model, wherein I have tried to explain it in the table. I explain it again that say, for example, there are 10 lakh rupees of total loans which has been disbursed in April 2022. The company has identified all the loan losses for this vintage over a period of 2 years. And then we calculate a vintage loss rate. So what I have done is that 10 lakh rupees the entity has disbursed in toto, that is in totality, in April 2022. And these are the loss rates which have occurred across the 8 quarters. This is what we have done. So we arrive at a loss rate of 0.1% in Q4. In Q1 of 2024, it is 0.5%. Q2 224, it is 1.5%. And Q3 224, it is 0.7%. Now, what we do is that we extrapolate it to other time period. So this is only one example which I had mentioned over here. In case of the other example, what we have tried to do is that this example I have tried to portray in a horizontal format. This is a vertical format. So I have tried to portray it into a vertical format. So what happens is that whatever loan has been disbursed in 2015, 10 lakh rupee loan I have taken for all the periods. This is the result over 8 quarters, and this is the expected losses. In Q1 2026, whatever loans was disbursed, these are the actual figures of loan losses. In 2017, the same thing. 2018 the same, and 2022 the same. So what I get now is actual history or behavioral pattern of loan origination period of 1, 2, 3, 4, 5. So 5 periods I have a entire history of what are the actual loss rates that have happened in the entity. Now, once the company has calculated, or rather the entity has calculated the expected future loss rates for each vintage. Now, this I call it as a vintage because loan has been disbursed in Q1 of 2015 and we have tracked it for 8 subsequent quarters. Now, why only 8 and why not 9? Because the time period of this loan is 2 years. So 2 years means 4 quarters. Sorry, 8 quarters. 1 year means 4 quarters. That is why we have taken it as 8 quarters. Then what happens is that in this, what happens is that now what we do is that assuming the original balance of Q1 22 losses were rupees was 10 lakh, the related allocation of current ECL would be 10 lakh into the average of all these rates. So this gives you an average of ECL of 18,860. Now, as someone has correctly mentioned in the question, as how can this be a ECL, or rather expected loss, as no other provision has been taken. Now, this obviously example is for understanding purpose. So this becomes your base figure. On that, you can add all the macro level factors. Now, typically in case of HFC, the macro level factors are that you can divide the HFC loan portfolio into 4 pieces, just for your understanding. One is the home loan salary. So the thing is that the borrowers who are salaried can be assigned a different level of risk or a risk segment. Borrowers who are actually self-employed or who run a business can be applied a different risk. Then housing finance companies also finance CREs, that is commercial real estate loans, and HFC LIG, that is low income group. So what will happen is that each borrower will portray a different behavioral pattern based on which you will arrive at a common ECL amount, and then for each segment, you can have a different risk rate aligned or assigned based on the macro level factors or typical behavioral factors which you feel which the entity deems fit. So this is the basis, and you can top it up with all the macro level and other factors which we have discussed. Additional analysis of qualitative factors will be needed and adjustments will be made to the expected future vintage loss rate. So this is only a base rate, which is for our discussion purpose. And based on that, you can add a lot more factors. This is only for example purpose. So now going to the next slide is the general approach. Now, this also forms part of the general approach, the roll rate method and the vintage approach. Why I was trying to extrapolate it, because then once we start discussing the general approach, it would be very easy for you guys to actually understand how we apply it in the normal scenario. So, I'll just see for any questions are there. No, I'll first, if any questions are there only related to this topic, I think we'll discuss that. somebody has asked me another question. So if only related to this topic till what we have discussed, I think is welcome from you guys. So we start with ECL computation. Now, first and foremost, let us understand what is the formula of ECL. So here, EAD is the exposure at default, a very important concept for everyone to note. Probability of default, loss given default, and the discounting factor, that is the DF, which is mentioned over here. Now, I think this is one of the most important steps to note. What is the exposure at default? So EAD is one of the key components for ECL computation. It is an estimation of the extent to which financial entity may be exposed to a counterparty. Now, I'll just pause it a bit. So when we say exposure at default, typically, say for example, everybody would be aware of the fact of funded exposure and unfunded or undrawn exposure. So say for example, I have a home loan of rupees 10 lakh rupees, right? Out of which I have had the disbursement of only 7 lakh rupees. Now, typically in the current loss incurred model, what happens is that out of the disbursed amount of 7 lakh rupees, I only end up providing, and for example, this turns into an NP. So what happens is that in the current scenario, I only provide for 7 lakh rupees and not the 10 lakh rupees. However, in case of ECL, what happens is that I again draw your attention to the first slide, which we saw, wherein we said that loan commitments and financial guarantees are also part of it, the ECL computation. So over here, I reiterate that 7 lakh rupees is only provided for in case of current method which is followed, rule based or loss incurred method. However, in case of ECL, what happens is that you also need to apply a CCF factor. Now, what is the meaning of CCF factor? Is credit conversion factor. You need to assume based on your behavioral tendency of the borrower as to what is the amount that he may draw in future till the loan defaults. So in simple terms, CCF is increase in exposure over period divided by available fund start of the period. So I'll just give you an example. I couldn't mention it over here because of the slides, but I'll give you an example. So just sticking to our previous example of a home loan of 10 lakh rupees, the total drawn amount is 7 lakh rupees till financial year 24, right? Now, in financial year 25, what happens is that this person draws another 1 lakh rupees. Now, what happens is that my credit conversion factor is increase in exposure over period. So in this 24-25, we assume that 1 lakh additional amount has been drawn divided by available funds at start of the period, right? So what happens is that what are the available funds at start of the period? It is 10 lakh minus 7 lakh because 7 lakh I have already consumed. 10 lakh is the total limit which has been assigned to me. So my credit conversion factor becomes 1 by 3 or 33%. So even though I have drawn a loan of 7 lakh rupees in T plus 1 period or at the end of the reporting period, I will add 33.33% to my available funds at start of the period and apply that credit conversion factor and arrive at the new amount which is will be called as EAD. So my new amount will be around 33,000 rupees. So my net exposure at default will be 7 lakh 33,000 rupees and not 7 lakh rupees. Second thing over here to note is that as per RBI has not come out with any regulatory CCF. So what do we mean by regulatory CCF? The thing is that in case of computation of CRAR, that is capital adequacy, what happens is that even though the capital commitment is there, it attracts 100% capital risk weight to that asset. So even though my limit is 10 lakh rupees, the client has only drawn 7 lakh rupees. the risk weight is assigned to the entire amount of 10 lakh rupees. Hence, in case of certain NBFCs, they have taken a call that while computation of EAD, they will have the computation at 10 lakh rupees, that is 100% of undrawn amount is added back to the ECL. In certain NBFCs, they say that we will have a behavioral pattern, and at the portfolio level, they'll take that 40% is the credit conversion factor. So 40% is just an example and a percentage which I'm quoting, but 40% has been derived based on past data as to what is the undrawn limits that a specific class of consumer or a specific product of home loans is being consumed by the end user. Based on that, the EAD is arrived. So in certain cases, in this example, when we say 100% of undrawn amount, that is 3 lakh, 10 lakh is the home loan, 7 lakh is the drawn amount actually disbursed to the consumer. The remaining 3 lakh gets added back to the ECL consumption, ECL provisioning methodology. And in certain cases where only 40% is taken, it is 40% into 3 lakh rupees. So 1,20,000 is added back to 7 lakh. So it becomes 8,20,000 rupees. So this is one of the most important factor to consider while making the ECL provision. If any questions on EAD, happy to answer. Okay, we move ahead. Now, this is the credit conversion factor. Second is probability of default. Now, this is also a very important term in case of computation of ECL. So when we say probability of default, it is a probability. I think we have a question. So what is EAD for this CCF example? So as I explained it to you, it is based on my historical data. It is 1 lakh divided by 3 lakh. So it comes to 33%. So it would be 33% of 33% of 3 lakh rupees. So it is not 7.33 lakh, but 7.9 lakhs, because 33% into 3 lakh rupees. And if you consider 100%, obviously it is 10 lakh rupees. Right. So in case of probability of default, probability of whether borrowers will default on their obligations in future, that is the meaning of probability of default. Historical PD is derived by the entity, which should be calibrated with forward-looking macroeconomic factors to determine the PD term structure. So what are the factors which we have already discussed before is inflationary concerns, rise in repo rates, etc. Forward-looking PD needs to reflect the entity's current view of the future and should be an unbiased estimate, and it should not include any conservatism or optimism, which we have discussed earlier as well. Now, the most important thing is rebuttable presumption. Standard contains a rebuttable presumption that default does not occur later than 90 days past due. So after 90 days, you have to recognize that there has been a default, and you cannot have any other data supporting it unless certain products like credit card, which we discussed before, have an empirical data to suggest that this is the case. Otherwise, to suggest that default can go beyond 90 days is very difficult. The credit risk on financial asset has increased significantly since initial recognition when contractual payments are more than 30 days past due. So these are the two basic rebuttable presumptions which are there in Ind AS 109, and that is how the stage 1, stage 2, and stage 3 has come into being. Basis one Ind AS 109. So 0 to 30 days is that period wherein you can say that even though there has been a default, there is no significant increase in credit risk. Beyond 30, the standard itself suggests that there has been an increase in credit risk, and after 90, also the standard says that it is a default. Now, what is loss given default? LGD is an estimate of the loss from a transaction given the default occurs. So when we say loss, it is total loss. I have a home loan of 10 lakh rupees. 9 lakh is what I have paid for. I am not able to pay any further amount above 9 lakhs. The bank has taken charge of my property, sold it off, and it has salvaged an amount of 50,000 rupees. So 9 lakh minus 9 lakh 50,000 rupees is the total amount which the bank got. That is 9 lakh 50,000 rupees. So 50,000 rupees is the LGD on that in that specific case. So it is actual loss which has happened to the bank. LGD is one of the key components of ECL model, and an LGD estimate has to be available for all time periods, and it has to be part of the lifetime horizon. So typically, LGD would be uniform across all these stages, because when I say loss ratio would be the same for a person who's defaulting in 0 to 30 days, 0 to 60 days, sorry, 30 to 60 days, or 90 days and above, because loss is when it actually the you have realized the asset, and whatever you are able to recover from that asset is divided by your NPA. So that gives you the loss rate. So it is uniform across the stages. It will not change based on stage. However, it may change based on product. So typically in housing finance companies, what we have seen is that in case of home loan salary, the LGD in case of housing loans in toto, the LGD comes to around 40 to 50%. That is 50% of the NPA amount can be salvaged based on the house which the entity has. In case of unsecured loans, the LGD can be as high as 70% because you have no security. So 100 rupees is the NPA. If you are able to salvage 30%, 70% is your LGD because you have lost 70% of the amount. And in case of commercial property as well, the LGD is a bit higher than housing loan. So obviously, if you have an NBFC dealing in all these sort of different products, you need to actually drill down to the product level and compute LGD at each level rather than doing it at the entire entity level. Discounting factor, ECL shall be discounted using EIR in order to arrive at PV of expected losses at the reporting date or ECL computation date. EIR might be used at account level or portfolio level depending upon availability of data. Now, obviously, we have to discount the ECL because we are saying that it is lifetime ECL. When we say lifetime, it will happen over a period of 12 months. So it will happen within 12 months from the reporting date. So if obviously EIR of what income is being recognized would be appropriate discounting factor to be applied for ECL. So say for example, in case of housing loan, if my EIR is say around 9%, the same EIR should be used for discount, EIR rate should be used for discounting the ECL amount. Now, stages of impairment. Stage 1 is because of the rebuttable presumption. Stage 1 is 0 to 30 days. Stage 2, 31 to 90 days. And stage 3 is more than 90 days. So stage 1 includes financial assets that have not had a significant increase in initial recognition or that have a very low credit risk profile at the reporting date. For these assets, 12-month expected credit losses are recognized and interest revenue is computed on the gross carrying amount, that is without deduction for credit allowance. So on a gross basis, gross portfolio interest is computed, even though, say for example, in case of stage 1, your gross amount is 100 rupees and it shows that over a period of time the loss rate is 2 rupees. Still, you will compute interest over 100 rupees and you will not net off 2 rupees against the 100 rupees. In case of stage 2, similar accounting policy will apply. And stage 2 loans are wherein the rebuttable presumption kicks in, that once your asset class or rather asset period changes from stage 1 to stage 2, we say that SICR has kicked in, which is not considered low, and lifetime ECLs are recognized. But interest revenue is still calculated on gross carrying amount. In case of stage 3 loans, which are more than 90 days in typical parlance, NPAs, which have happened, includes financial assets that have an objective evidence of impairment. So we say that impairment has happened and there is a low chance of recovery. For these assets, lifetime ECL is computed. However, interest is computed only net of credit allowance. So say for example, 100 rupees is NPAs and 60 rupees is the provision on that. So interest recognition is only on 40 rupees and not the 100 rupees as opposed to stage 1 and stage 2. Now, when do we say that there is a significant increase in credit risk? Uh, First is the rebuttable presumption. So, for all the NBFCs, HFCs, if you see the disclosure, everyone has stage 1, stage 2, stage 3, and everybody would be saying 0 to 30, 90 to and above 90 would be stage 3. So, that is derived from NDS 109 rebuttable presumption. This presumption is not an absolute indicator, but is presumed to be minimum point at which expected credit losses should be recognized even when using forward-looking information. 30-day presumption can be rebutted only if the entity has reasonable and supporting information. Now, clear case would be credit cards in this case, but for other products, it is very difficult to say that there is a reputable presumption in this case, and it does not represent a significant increase in credit risk. In case of corporate portfolio, internal rating becomes a key indicator which can suggest that there is a downgrade possible, and which plays a significant role in deterioration in credit quality. Hence, obviously, wherever NBFCs are at the matured level and they have lent to any corporates, uh, in their uh, in their sanction letter, it is mentioned that credit rating would be carried out after a periodical while. Typically, it is 1 year, and basis that the facilities are renewed. If it is a term loan, obviously the periodicity may differ from case to case basis. However, a external credit rating also helps in that case, wherever CRISIL or ICRA or whatever credit rating agency has been mentioned in the contract by the NBFC, the entity is required to get that credit rating. Based on that, the NBFC takes that into its ECL and computes the rates further. In certain cases, obviously, the NBFCs are also accustomed to create internal credit rating matrices of all the clients, because in certain cases the clients would not be able to afford the fees of the rating agencies as well, and in certain cases they don't take it. Practically, they don't take it. So in such cases, what happens is that the NBFC itself has internal chart basis which a rating is done based on the audited financial statements and a chit chat with the management, based on which an internal rating is assigned to the corporate, and on a periodic basis it is revised. So any fall in credit rating should be captured in the ECL. Now, it isn't necessary that a drop in credit rating means an increase in ECL. It is very subjective, and it also needs to be seen what is the appetite or risk appetite of the NBFC and what is the EAD. At the end of the day, what is the exposure which is open to risk? So all these factors would play a key role in determining the SICR. Now, what are the other possible SICR indicators? First is a no-brainer, number of days past due. Second is multiple notch internal rating downgrade vis-a-vis original credit rating. Now, the main thing to see over here is that in certain cases, you actually need to go through the credit rating reports, and then also you can say that this rating downgrade may be a temporary phenomenon, because in certain cases, practically, I have seen that due to certain spike in raw materials. Classic case was that Ukraine and Russia war, wherein a lot of commodity prices went through the roof, and the credit rating of lot of companies exposed to commodities were hampered, wherein there was a downgradation of their credit rating because there was a huge impact on their EBITDA, basis which their profitability was skewed to a larger extent. So in those cases, as an auditor and as a management, obviously a call can be taken that whether this is a long lasting thing, or you will see the client will come out of it unscathed. So it is very subjective, but these are certain factors which we need to take care of. Third pointer is restructuring carried out to assist the borrower. So what do we mean by restructuring is that in order to assist the borrower to repay his current loan, say for example, if a loan has been given to a borrower for a period of 5 years, it can be extended up to say 7 years or 8 years based on the understanding and discussions with the borrower. However, in this case, whenever it is a trigger or wherever you can audit that forbearance is given by the bank to the borrower in case of restructuring, it is trying to help the borrower to repay its dues, albeit over a longer period of time. So these are indicators which suggest that there may be a dip in the credit worthiness of the borrower. Third is borrowers in particular industry under stress. So as I just discussed, high commodity prices was a classic case in case of the Russia-Ukraine war. Auto ancillaries, now it depends on the cyclical nature of industry. Before COVID, the auto ancillary obviously was not in great shape. Now, because of pent up demand and other factors, it is on a upward curve. However, you also need to see the industry cycle. Say, for example, classic case also can be real estate, wherein earlier for last 10 years it was down in the dumps. Honestly, from 2010 to 2019 odd. Post COVID, it has again started ramping up. So you need to see these indicators. Say, for example, if you are a supplier of building material to these builders or developers directly related to real estate sector, you need to take into account the changes in the macroeconomic factors and then come to a conclusion whether the risk towards the customer has increased or not. I have a question from Parikshit. Will comfort letter guarantee from a parent help in reducing SICR? Yes, definitely. It will help in reducing the SICR, but also you need to see the credit worthiness of the parent. In certain cases, we have seen scenarios where it is at the same credit rating which has been given to the subsidiary. So these are certain things which you need to check, but definitely a guarantee letter from a parent helps. A borrowers in particular region under high political risk. So a risk. So one thing which comes to mind is the Manipur in recent times. However, obviously, given the economic development in that particular area, seldomly you will find borrowers located in that area. But this is a precursor or a conceptual clarity that it can happen in any of the, God forbid it happens, but if it happens in any of the areas, you need to take cognizance of it. Typical areas wherein floods are a natural phenomenon are the Kolhapur and Sangli belt, wherein a lot of SMEs are located. So in certain NBFCs, we have seen that in such cases, a higher ECL is taken for such borrowers basis the earlier behavioral trends and the losses which the NBFCs has faced because of incessant flooding. Borrowers who are part of watch list. So each bank or a financial institution, NBFC, maintains a watch list. So when we say watch list, it is kind of a monitoring list of borrowers who they feel are not at par their credit worthiness. So there is a list of such borrowers. You need to check this list and see that what is the credit rating which has been given to them and whether the as part of our audit procedures and whether SICR has kicked in for such borrowers. If yes, whether it is a material credit event or it can get covered in your overall ECL computation. So these are practical scenarios where you need to take such calls. Breach in financial performance covenants, par level profits, EBITDA. Now, par level is typically at the NBFC level. So this I have included because as part of our audit of wholesale NBFCs, these are involved in giving loans to NBFCs catering to the unbanked sector. So, say for example, microfinance entities, people who are into that small finance bank category. So, in this, what happens is that par level, that is portfolio at risk. So, say for example, there is a concept as par 30, par 60. So, what do you mean by par 30? Par 30 means that my portfolio between 0 to 30 is, say for example, 10% of my total portfolio, and par 60 is, for example, 20% of my total portfolio. Now whether this 10 decreases, so par 30 decreases means that stress is building in the book. Par 60 increases again means stress is building in the book. So these are part of your covenant agreements with the NBFCs that if par 30 breaches above 15%, I will have a demand call on your loan that you have to pay immediately rather than whatever period has been agreed in the contract. So these are some of the criterias or contractual obligations which you need to have an eye on, which are a kind of a factor or a trigger which can help you in identifying SICR. Now, what are the other qualitative factors? So earlier were more of general qualitative factors. Now, what are the qualitative factors affecting ECL? One is basis of stage allocation of financial assets for computation of ECL. So key factor here is define the SICR criteria for various portfolios depending upon the risk characteristic required for stage allocation. Now, here, what I'll see is that when I say stages, I had just taken an example of housing entity, the HFC, housing financing entity, wherein you can actually segregate SICR according to their portfolio. So one can be for home loan salaried, one can be for home loan self-employed or business, one can be for CRE, one can be for low income group, because the behavioral patterns of these products or portfolios are completely different or unrelated to the other portfolios. So this is a qualitative aspect which you need to bring in the ECL model, and also backtest it whether our hypothesis is correct or not. You need to backtest a lot of data, and typically in HFCs you will be saddled with a lot of data once you are following that vintage model. Second is default definition for various portfolios should be based on indicators. Breach of covenants, which we just explained, 90-day rebuttable presumption. Segmentation of portfolio. Now, each NBFC may have different portfolios as well. Now, when we say housing finance company, an overall homogeneous product is of housing loan, and in that we have drilled down to identify housing loan taken by salaried people, housing loan taken by business, housing loan towards CRE commercial property, and LIG, that is low income group. However, in case of NBFC, they can have different products as well. When I say products, sorry, they can have different portfolios of products. So, say for example, gold loan will have its own share of risks and rewards. SME loans will have its own share of risks. Unsecured loans are a completely different animal, and HFC loans are different. So we are handling entities where all these loans are under one entity. However, ECL computation is completely different for all such products. So say for example, for gold loan vertical, the ECL percentage is very low because you can sell gold in open auction market and realize almost 95% of the value, which the data suggests. Obviously, in gold loan, what happens is that fraudulent cases are more than housing loan or CRE loan. So even though the gold loan percentage ECL may be lower, you need to incorporate forward-looking assumption that in, say, historical 5-year period data, I have seen X amount of gold losses due to theft, or the purity of gold is not up to the mark. So each portfolio, each vertical has its own risks, and you need to identify it and subsume in the ECL model. In case of SME loans, I think typically the thing that comes to my mind is that once the loan turns into NPA, it is extremely difficult to sell off that property, because in case of an SME, that person is actually using that property to generate business and generate cash flows for the entity. So it is a catch 22 situation in case of SME loan, as to you cannot oust the owner, because if you do that, then there are no chances of recovery happening from his business, but you have to sell it. And obviously the promoter doesn't let go of his property because it is the only family jewel he has. So each portfolio vertical has its own risk which you need to incorporate. In case of unsecured loan, there's no security at all. So the LGD is extremely high level. In case of gold loan, LGD is extremely low. SME, it is in somewhere in middle, and HFC loans also it is very high. The LGD rate is low. That means the recovery rate is high. Now, probability of default. Management may choose to apply generally acceptable approaches for PD modeling based on entity size, complexity, risk profile of the entity. So there is no right or wrong method in computation of PD. Only thing is that it should actually be commensurate with the nature, size, complexity of the entity, and proof of pudding is in eating it. So you need to backtest the data to see whether it is correct or not. And when I say correct, the thing is that how do you say it is correct, right, or wrong? What the ECL computation is? So what you need to see is that in the next slide, we'll just come to this topic because an entire slide is dedicated as to how do you say that it is right or wrong based on the current scenario. So just park that question over here. Macroeconomic indicators to be considered for futuristic considerations: inflation, interest rate, currency fluctuation, GDP outlook, economic growth, and unemployment rates. Now, just for the sake of it, you shouldn't include all such jargons in your ECL model, but actually, you need to be choosy as to whether unemployment rates hamper your client, whether inflation hampers the entity's client, interest rates hamper the entity's client. As I told you, interest rate is a classic example for builders because their end user is dependent on the interest rate which is offered to them while buying a house. So all these factors are very important. Now, the next important topic is prudential floor for ECL. Now, when I said that, just park this question. So this. Now, how do you say that probability of default or an ECL model is correct or not? Now, honestly, RBI was also grappling with this because hitherto NBFCs were using loss incurred model or rule based IRAC norms, IRACP, IRAC and provisioning norms provided by RBI. So based on that, RBI was at a comfort level that this is the amount of provision that is required for this entity. But after implementation of ECL, what happened is that obviously each entity implemented ECL in his or her ways, and also interpreted the implementation of ECL according to their own needs. So typically, what happened is that there was a skewed ratio coming in the numbers that in case of HFCs, they were going below the IRAC norms because they said that our LGD is very small and hence our ECL is a bit lower than IRAC. In case of unsecured loans, what happened is that most of the NBFCs catering to unsecured loans, in their case, they were much higher than the IRAC norm. So in order to have a benchmark of the provision, what RBI has done by way of circular dated 13th March 2020 is that they have said that each of the NBFCs would disclose in their financial statements what is the provision as per ECL and what is the provision as per IRAC norms. So even though IRAC norms are not applicable to NBFCs, they need to compute the IRAC provision based on the extant current norms which have been provided by RBI. So in certain cases where the NBFCs were taking provision lesser than IRAC norms, RBI has suggested that you need to take an impairment reserve, which is to be taken post profits, and you need to keep it as part of reserves in the balance sheet, and you cannot draw them without prior RBI permission. So this is to discourage entities to take ECL lower than the IRAC rate. So this is the benchmark which currently RBI is using. Most of the NBFCs apart from HFCs are having or carrying ECL provision, which is more higher than the IRAC norm. So that is a benchmark. Now, in case of ECL computation, the most important thing is that what is the board approved policy and what is the methodologies for computation of ECL, whether it is commensurate with the size, complexity, risk profile of the NBFC, any adjustments done to the model, to the entire model. Revision of estimates happen, and you need to see whether the ACB has taken due cognizance of it. ACB should also approve classification of account that are beyond 3090 DPD and still not classified as SICR or impaired. So you are basically rebutting the presumption which is mentioned in the Ind AS 109. For that, rationale should be mentioned with empirical data and should be approved by ACB. It is also recommended that definition of default adopted for accounting purposes guided by definition used for regulatory purposes. Now I'll just try and stop sharing my screen, and what I'll do is that I'll just try to share a practical example which I have created specifically for this session. Yeah. So is my screen visible? If you can just, anybody can tell if is my screen visible, it would help me. Yeah, okay, great. So I'm thinking that it is visible. So now we just come to the practical side of it. Now, how do you implement the ECL model? So first and foremost is knowing that what is the EAD, exposure at default. So over here, I have considered a plain vanilla concept wherein I am suggesting that the POS or portfolio outstanding as on this date, M19 is March 19 and M20 is March 20. So POS and EAD are the same. So there is no undrawn portion of it. So when computing the PD, what happens is that you need to take NPA as on March 20, that is the reporting date, and POS as on March 19, which is under the stage 1 category. So I get a PD of 0.55%. I repeat again, how do I compute probability of default is that I have considered NPA, that is NPA on March 20 divided by POS appearing on March 19. And I do it so this is an NBFC which is catering or rather giving gold loan, housing loans, microfinance and other small ticket loans, not microfinance, small ticket loans. So over here, what is happening is that it has a vast spread over these states. So what I have tried to do is that in this example, I have tried to collate all possible scenarios of computation of ECL. So it covers the state-wise analysis as well. It covers the year's vintage that has been computed, and it also covers the other qualitative factors or how the probabilities are assigned. So over here, we computed the PD. Similar PD is computed for 1920 in stage 2. So mind the fact that this is stage 1 assets. These are stage 2 assets. So stage 1 PD for Chandigarh is 0.55% in 1920. 2021 it is 2.41%. 21-22 is 2.3%. 22-23 is 3.15%. And 23-24 is 3.73%. Now, over here, a peculiar thing that you need to understand is that this was a COVID period. All the data which is here is a COVID affected period. So, for this entity to apply ECL, you need to take into mind a forward looking approach. So, in this, when we say a forward looking approach, you cannot have PD rates of 2021 because if you see the PD has substantially increased in 2021 and 2022 vis-a-vis 1920 because this entity is operational from 1819, so we only have that much of data and it went into crisis because of COVID. So if you see over here 2.41% and 2.3% and 3.15%. Now this has happened because of COVID. So what we did is that first is computation of PD at all the state level. So whatever number of states are there, a PD has been computed. I just showed you what is the computation. So same loan data is considered which was outstanding as at March 19 and which became NPA. Yes, obviously, what is the starting point? The opening balance would be the previous year. As I explained earlier, T and T plus 1. So this is T plus 1, this is T. And then we average out for 21-22, the average of earlier year, so to get the POS. So average POS or portfolio is portfolio outstanding on March 22 plus portfolio outstanding on March 21 divided by 2. Now here, as part of the ECL documentation, what we decided is that I'll just also show you the LGD working. So this is loss given default. As I told you, this is actual loss that has happened. So LGD is as high as 75% just because it is unsecured loan. So loss divided by NPA gives you the LGD percentage. And this again is computed for all the states. Now, this is LGD, exactly the same logic as we have had for PD. Only thing is that LGD would be constant across all the stages and PD obviously would not be. So in case of PD over here, what we have done is that we have shifted the base from 18, 19, 20 to 22, 23, 24. And what we have done is that we have allocated 45% to 22, 35% to 23, and 20% to financial year 24. Now, there are a lot of data crunching happening why these rates were taken. One can argue it can be 50, 25, and 25 as well. So, just for the sake of this example, I have taken these rates. So what we have said is that we have shifted the base year from 18, 19, 19, 20, 20, 21 to 22, 23, and 24 because we need to take out the COVID period. So this is the data rationalization that you need to take. Just because you are following a vintage methodology doesn't mean that you will be taking the affected periods in which there was such an event, kind of once in a century event, which will hamper your future projections as well. Now, what we have done is that we have assigned probabilities to these years, and when the PD is computed, we have also tried to straight line the PDs based on the weightages assigned. So this gives me a PD of 1.97%, that is the average of all the states. And in stage 2, this is 10.78 of all the states together, right? So this is what we have done over here. In case of LGD, I have explained. Now, coming to summary, the thing is that in case of stage 1, the EAD is 3540. The PD is 1.97. Now, this PD is taken from here, 1.97. Then we again go to the main summary sheet. Stage 2 PD is 10.78%. So this is 7.78%. And third, obviously, stage 3 would be 100 because NPA would be the same. Now, this is the LGD which has been derived from all the states. So what is happening if you see over here? For Chandigarh, it is 69%. For Haryana, it is 64%. For Uttar Pradesh, it is 57%. Now, it is practically not possible to compute LGD and ECL for each state. So when you have a portfolio approach, what you try to do is that gather data and then straight line that data. You can take a weighted average, simple average, whatever you want. And I'll also tell you what is the benchmark or rationale behind it. So we have arrived at 62.89% as LGD. Now, most important thing is the discounting factor. So over here, the EIR rate was 1.15%. So what I have done is that we need to discount it for next 1 year. So 1 divided by 1.15 gives me 0.87, and this is the ECL rate. So my provision is EAD into PD into LGD into the discounting factor. That gives me 38 crores, and total provision is 653 crores. Now, in case of LGD, what happens is that if you don't have empirical data, where do you start? So RBI has actually published a financially stability report, and in that, for unsecured lending, typically it has said that average LGD can be 60%, medium macro scenario can be 65, and severe can be 70. So kind of COVID and other stuff. So if you see, our LGD is around 62.9%, and it is supported by empirical data that historically, if I'm saying that my LGD is 62.89%, I will take that rate rather than taking 60%. So I have also incorporated my historical data in this rather than blindly sticking with 60%. And this is for my unsecured portfolio. You can have each, in this case, you can have other products as well. So this is only for unsecured portfolio. For secured portfolio, we take HFC example, and these are actual arrived rates. So for HFC home loan salary, LGD is 20%, home loan business is 28%, CRE is 50, and LIG is 50. So this all is basis the empirical data. So ECL working for this will be different because the LGD is different, the other factors are different, and ECL working for all these 4 products would be different. Now, as we discussed earlier, management overlay and macroeconomic overlay, whether they are to be considered or not. Now, if you just have a look at Bajaj Housing Finance, they have considered around 94 CR as management overlay or macroeconomic overlay. Now, it is honestly just a blanket by now, whatever name you call it. It is board approved figure. So obviously, whatever the board feels, you can take it. Now, as a benchmark, you say that my IRAC provision is say around 500 CR. So if you see that my ECL provision is 653 and my IRAC is 500, you can be rest assured as an auditor that you have around 100 CR or 150 CR additional cushioning provision which is available, and all this data has to be published in the annual report. So it is not any secret, or it is a data available in public domain. So if you see in case of any NBFC, you will see these figures. So say for example, if it is 500 for IRAC, that is as per RBI guidelines, and ECL is 600. So you have an appropriate amount of cushion available. And if you still add 94 crores or 100 crores as your ECL model, obviously it also depends on the profitability of the enterprise and what are the management plans. But then you can rest assured that this is appropriate amount of provisioning that you have taken. I'll just stop sharing my screen. Yeah. So now we are back again to our accounting and auditing issues. I just wanted to give you a flavor as to how the ECL model is built up rather than just discussing it in theory. Hope you found it useful. And obviously, this is a base model. In case of HFCs where there are loans of 20 to 30 years, another thing is applied is you need to compute the PD, or what you call is the median PD, which can be actually derived from your earlier vintage data. So now moving to the next auditing and accounting issues. So this is a just a summary of all the ECL issues which I have encountered honestly, and based on other experiences within our firm and outside our firm as well. So governance, risk of high probability of management bias and significant estimation. See, at the end of the day, obviously corporates are here to earn profits, and there is also a lot of management. Sometimes a management bias is involved regarding profitability. So estimations can be tinkered according to your profitability. That is where the auditor needs to step in and see what is the empirical data suggesting, and whether the data what is it is suggesting has been subsumed in the ECL model. So that is what you need to do. Second is board approved ECL policy, the detailing, periodicity of review, assessment. So typically a board policy is revised once in a year. However, we need to understand that what is the difference between policy and what is the difference between change in estimates, which can happen quarterly. So policies that, see, for example, a major change in policy may be to subsume the management overlay in the ECL model itself. Other change in policy may be that when I say there are loan commitments and I will use 100%, 100% as a ratio for conversion of the CCF factor. Earlier it would have been 40, now we have changed it to 100%. So these are changes to the ECL model. However, if my LGD changes from 62.5 to 60, it is not a change in ECL model, but it is only a change in estimate. So this is a fine line, I think, which we need to understand. Change in ECL model has a huge impact and it has a lasting impact, and you actually need to dig in deeper as to what emanated or what happened for this change that you were not able to foresee as auditors. And you can also definitely challenge the management and see what the back testing data suggests, whether the management is correct or not. Where the debate typically happens is basis the forward looking statement, because the standard also suggests and practically the management has the best estimate of any future events. However, definitely you can rationalize whatever data is available and see whether it is happening or not, and again recheck it or test it on a quarterly basis if possible. Significant variations put up to the board, as we have discussed, whether ECL results are used for decision making or it is only for accounting fiction. Now, this is also very important thing. If management is not using the ECL results, then it is only kind of a model which is restricted to in the accounting parlance. So if it is not using it in decision making, the management doesn't have the conviction in the ECL model. So just to give you an example, when we say that there is a lot of stress which is appearing in say PAR 30 or 0 to 30 days, what are the steps that the recovery department has taken to correct it? or if the management has a conscious decision saying that it will require 6 months for the stress to subside. So something like that. You need to see what is the evidence which is at play as to whether the management is using ECL results in their day-to-day business operation. Risk management department plays a very key role in developing the ECL model, because all the macro level, micro level indicators are there with the RMD, and it is a main department which gives inputs to the ECL model. Now, obviously, I have written over here risk management department. It may be called by any other name in other companies. Typically, it is called as risk management. So RMD has a major role to play in developing ECL methodology based data with the entity and comparable market practices. RMD also needs to develop an approach for computing various ECL components, PD, LGD, EAD in conjunction with other departments. So, say for example, I know that my LGD percentage is rising. The RMD or the entity shouldn't wait for the auditor to tell them. Obviously, they have the data, they do test it on a periodic basis. And this is one of the pointers that the company is not serious in implementing the ECL model. That if your LGD or PD has changed, they should be the first one to pick it up and also bring in the remedial measures. Suggest qualitative staging criteria based on current and future economic condition, including management overlay in cases of uncertainty. So, in case of COVID, it was a classic case wherein many people started taking COVID overlays, because honestly, it was impossible at that point of time to say that COVID would be over by 1 year, 2 years, or 2 months. So, what is a management overlay? That it is an ad hoc amount computed, kind of a buffer for the rainy day, that is COVID, and it was subsequently consumed in the ECL, or it was returned back in the provision. So this is how people used management overlay. However, certain groups like Bajaj are still persisting with management overlay. And as part of their RBI inspections as well, we have seen that RBI is fine with still carrying the management overlays, even though COVID is not there. So now they have termed it as macroeconomic risk. It is kind of a blanket for the company in case something goes wrong. Validation or backtesting of existing ECL models, actual data versus forecasting data. IT department, it is one of the most important departments, honestly. In sync with risk and finance department, needs to perform gap analysis on a periodic basis to have comfort on data being used for ECL modeling purposes. Now, we have seen from the example and what we have discussed from inception, data is the key to all the computation. So, IT department needs to see that the data which is culled from the loan module is tying with the books or reconciling with the books. So, in certain cases, we have seen that IT has given a report of cost of say around 10,000 crore or AUM, while finance department is struggling to tie up that number. Now, just imagine if that number is not tied up, your ECL provision obviously goes up in the air. So if your AUM is 10,000 and ECL is only computed on say 950 CR, that will cause a disaster. So you need to first see that the IT system works in sync with the finance department, and the AUM which is generated from the ERP matches with the AUM which is on books presented in the financial statements. Amounts other than ECL which are there, management overlays, IREC alignment. Now, this is another issue which has come up to the fore post that March 20 circular. Now, over here, what has happened is that what does IREC specifically suggest? People doing bank audits would know that RBI has come up with the circular in case of IRACP, not a new circular, but IRACP circular is refreshed every year. In that, what it says now is that until the entire overdues are serviced by the customer, it will not change the staging criteria. So, for example, it still continues to be an NPA. So, say for example, Sanat Chitale took a loan of 1 lakh rupees. It is now NPA. The amount is 1 lakh rupees, 90 days past due. And if Sanat Chitale pays an amount of 20,000, what does RBI say? That you cannot reduce the amount, or rather, you cannot upgrade the account as NPA just because he has paid 20,000. Obviously, 20,000 would be knocked off against my 1 lakh rupees, and my dues would be 80,000 rupees. So in IRAC model, it still stays as NPA. However, in case of Ind AS 109, the ECL model suggests that if I have paid some amount, 1 lakh becomes 80,000. The amount which is beyond 90 days is, so for sake of this example, consider that total amount is 1 lakh rupees post 90 days. And out of that, 20,000 pertains to actual DPDs, days past due above 90 days. So if I pay 20,000, my overall exposure comes down to 80,000, and this 80,000 now goes to 60 to 90 bucket, or rather 30 to 90 bucket in case of ECL. So this was a disconnect between IRAC and ECL. Basis this circular, some of these companies have tried to align their ECL model with IRAC, and it is a mixed bag. There's no right or wrong, but certain companies have said that, as RBI says, that I will not upgrade my account from NPA to PA. The account still would, even in ECL, still continue to remain in that 90 days bracket, and it will attract a PD and a provisioning of 90 days only. Certain NBFCs have said that ECL and IRAC norms shouldn't be aligned together, as in any case we are giving the ECL versus IRAC provisioning status, so we will follow a pure IRAC methodology. In certain cases, hybrid models are also been adopted, wherein they say that I will change my bucket from 30 to 60, or rather 30 to 90, and that 80,000 would be carried as part of my 60 to 90 bucket. However, provisioning will be taken as per 90-day bucket. So each NBFC has tried to interpret this circular in their ways, and this is where things stand. So it is a mixed bag. So you need to see, as part of your audit, what call the entity has taken, and the most important thing is that this should be mentioned in your notes to accounts. Whatever IRAC alignment call the company has taken, it needs to be disclosed in your notes to accounts. Fraud cases, obviously 100% provision is taken by all the entities. Haircuts considered for reduction in security value while computing LGD. Now, typically in case of home loans, what happens is that many times the management or the entity realizes after the loan has gone bad that the valuation of the property actually was only 50 lakh rupees. However, in order to avail the loan or due to fraud, it was jacked up to 1 crore rupees. So in such cases, LGD computation becomes very critical, and we have seen mostly in NPA cases, or cases where it is self-financed or a business loan, that such cases do occur. So this can be one of the factors which should be incorporated in the LGD computation. Verification of arithmetical accuracy of ECL computation. So typically auditors are supposed to verify are supposed to verify and test the ECL computation. It is the job of the management to actually do it and give it to the auditors. So verification of arithmetical accuracy is of utmost importance, because the data is so vast and so huge that you need to actually deploy a lot of quality resources to test this data, because even a single error can be an issue at a management, or so rather at the financial statements level, and it can turn into a material misstatement. ECL versus IRACP and creation of impairment reserve, which we already discussed. So yeah, this is it from my side. If there are any questions, I'll be happy to answer them.
There are a few questions on chat box which you can take up if possible.
Yeah, sure. So Chandan, what I can see is the last question is ECL applies. So ECL applies to all the entities regulated by RBI, considering their net worth about 250 CR. So it is applicable.
Okay, I think so. I think so for all the uh, uh, all the people who joined today's call, Sanat.
Yeah.
I think so. It was very enriching for them, And anyways, as you are aware that this topic is not very simple for
Yeah.
auditor, for company, everyone. So first of all, ICI is fortunate that you could spare time, take this session. And what I could see, uh, most of the people have joined from Mumbai. There are few people I could see from name, they have joined from industry. So normally whenever a session is done at ICI, they mostly practicing chartered accountants join. But I could see more than 20-30 people join from industry, because from an industry perspective also they want to have a lot of clarity. And I think so. Uh, you solved their queries and doubt throughout the session itself. So it was very wonderful. Thanks once again for your time, effort, and for
So
others.
Chandan, it was an absolute pleasure and privilege to present in front of such an august audience. I would also like to thank you in person for reaching out to me, and I hope I could add some value regarding this topic to our audience.
And one thing, Sanat, for this, whatever 50, 60 people, whoever joined and were there for full time, it's a non-CPE session, Sanat. So you can understand what's the importance of non-CPE session, people attending for full 120 minutes. That was an added advantage for
I
the
hope
people.
I was getting some. So you have just cleared the air, right?
So it's a uh, unrecognized or unstructured CPs for this
Okay.
normally. So that way. But thanks for everything, and definitely thanks on behalf of ICA, and thanks on behalf of all the participants who joined. And uh, yes, Krishna, we would invite Sanat very soon to BKC in person. Sure. So there is a request, Sanat, from uh, few people to do in-person session.
I'll definitely try.
Sure,
Even the other commitments, I'll definitely try and do that.
sure. Thank you. Thanks,
Yeah.
Sanat. Thanks, everyone. Uh,
Thanks a lot for listening patiently.
yeah. We can stop the recording.